there's been some pretty decent developments in the U.S.-China relations this week. Meeting between Xi and Biden seemed to be okay. The Chinese economic data has been improving a little bit, but the stocks are still down in a rut. Let's talk about what the economy needs to do next in China. Shaun Rein joins us, Managing Director at China Market Research Group. Shaun, thanks for joining the Schwab Network. Appreciate you being here.
Oliver, it's great to be here for my debut appearance on the Schwab Network.
I love that. Thank you. Love the energy out of the gate. So the thing, I guess, to start with, to me, that far from a China expert, I've been trying to figure out is the stocks have been still so depressed, but it seems like the worst of the economic malaise has passed. Am I wrong on that description? How do you make sense of that relationship?
Well, that is a concern. So we need to detach the economy from the Hong Kong equity market.
Okay.
So let's split the two.
Sounds good.
So the economic situation is not great, but it's much better than a lot of investors realize. You've seen retail sales have gone up about 7.4%. The Chinese government has launched a $100 billion bond stimulus program. They've announced that they're going to front load 2024 with the proceeds from this bond sale. So I expect the real economy to do a lot better. But here's the problem, Oliver. The Hong Kong equity markets, the Chinese A-share markets remain in the doldrums. And that's because investor confidence just isn't there, especially the international investors. So I've met with about 200 hedge funds from the United States in the last 3 months, and they're saying, we're nervous about China. We think that there's going to potentially be a war over the Taiwan Straits between the US and China. We're worried about geopolitical tension. Right now, we're just not going to invest in Hong Kong, and we're going to look to other Asian equity markets like Japan, which has really been soaring in the last few months. So I think you pose a great question, Oliver. Why are the equity markets so bad when the real economy is actually improving? So look, I'm not a stock picker, but this might be a time for hedge funds to sort of slowly get back into the marketplace, because I think the economic numbers for 2024 are going to outperform market expectations, and you might be hitting a bottoming of equity valuations in Hong Kong.
It seems like the sentiment around the sort of geopolitical tension is perhaps overwhelming some of the narrative with regards to China. So the actual data itself you see as having troughed, and that's a GDP basis. What do you base that on?
Yeah, so there's a disconnect between the equity markets and the real economy. People are just too nervous about the geopolitical situation. And even though that there was a mini detente of sorts between President Xi and President Biden this week in San Francisco, the fact of the matter is Biden still has really oppressive sanctions on China. So a lot of the top Chinese companies like a Huawei, like a Hikvision, can't be sold in the United States and can't even buy American products like the top chips from your previous guest was talking about from NVIDIA. So overall, people are nervous. And Biden has also prevented and is in back rooms pushing hedge funds, mutual funds, not to invest in China right now. So there's a lot of pressure on the equity markets there, which is why I'm actually fairly negative on the Hong Kong equity markets because of this pressure, though, like I said, prices might be bottoming out. Now, I do like the A-share markets a little bit more in China. You have to be really cautious. That's kind of like a casino, because most of the investors in the A shares are actually individual Chinese retail investors. So they put money in and they get money out very quickly. So the A shares are not dominated by big investors like a BlackRock or a Fidelity. They're dominated by a mom and pop investor who, the whisper of a rumor, will bounce in or out of the markets.
Yeah, I like that distinction of the demographics behind each market. So what do we look for then to know if their economy is regaining steam? What are the important measures? Is it just labor-based, or is it going to be activity? What are the key kind of technical measurements to watch here, Shaun?
Well, there are a couple of things. I think the first is about 70% of economic growth right now is based off of consumption. So the first thing that investors need to look at is how are retail sales? And like we found out in October, they grew about 7.4% year over year. That was from a very low base, but that's still a good number. And I expect consumer optimism on the low and middle class to continue to rise. So the first metric investors should look at is retail sales. The second is youth labor market. So the labor market, was at a 21.3% unemployment rate over the summer before the government stopped issuing announcements on the youth unemployment. If you talk to people like me who run a research firm in China, I'm actually in Shanghai right now, then you'll see that the unemployment rate is getting better. It's getting easier and easier to get jobs. It's still not necessarily the jobs that young people want. It's not necessarily the salaries that they want, but it is starting to come back. So that's number two. And then the third thing I'd look at is FDI. So FDI dropped about 8% so far this year, year over year. But when we talk with multinationals, a lot of them say they're coming back into China. So Oliver, I'll give an example. I met with a C-level executive of one of Germany's largest brands. Okay. And he said to me, Shaun, 2023 was India. 2024 is China. So we're going to head back into China in 2024. So look at FDI, look at youth unemployment numbers, and look at retail sales. That's what investors should be looking at to see whether China's coming back from its sluggish 2023 economic start.
All right, love it. 5% GDP, think China could do in 2024, looking at your notes right now. You mentioned the foreign companies also. Are there any American, any U.S.-based businesses you feel have potential growth there that we haven't already talked about? Like the chip makers we've all been focused on. Last year, people were thinking a lot about Starbucks and stuff. Any kind of wild cards on the China market that might be getting cracked open by any U.S. companies?
So I'm fairly negative on Starbucks, actually. They're being outcompeted by Luckin Coffee because Luckin is cheaper. So Starbucks is bouncing a little bit back, but they're discounting 20-30%. What I really like would be UGG and Hoka. So Deckers Corporation with the UGG shoes, they're launching and going heavily into Hoka in 2024. Sports apparel, running shoes are really quite popular right now, especially running, because during the COVID period, people couldn't go into gyms for several years. They were closed. So people started to pick up outdoor running. And so Hoka, I think, is well positioned. The second one, you can see, I'm in my closet in Shanghai, but you can see behind me, I got a Pilates machine because for so many months I was locked in this house actually during the Shanghai lockdown. So the second brand to look at is Lululemon. All the women are going out and buying Lululemon. So men are buying Hoka, women are buying Lululemon. Those are the two companies I'd recommend investors look at right now.
Great stuff, Shaun. Love the details. Appreciate it. We'll definitely keep the convo going.
Thanks, Oliver.
Absolutely. Shaun Rein, Managing Director at China Market Research Group. All right, some good stuff from the macro into the micro there.